When the prevailing trend is up, why would you want to look for short entries when buying might result in much smoother trades? In this video, we are going to learn how to identify the trend in the Forex markets. Markets can do one of the three things, which are going up, going down, or move sideways. So the biggest question is, how exactly can you see that? But before we jump into the war video, please make sure you check out our free signals Telegram channel. The link is down below. The picture below shows you the three possible scenarios and how the market keeps alternating between the phases. In this case, we have the first phase, which is the rally rise. As we said earlier, that the market rises. We have another phase, which is the ranging phase. The market is basically it doesn't have a bias. It's neither moving up nor down. Then another rally, a ranging phase, and the last scenario, which is a sell off or a drop. So the first method of identifying the Forex trend is using the highs and lows. Conventional technical analysis says that during an uptrend, you would see higher highs because the buyers are in the majority and push the price higher, and the lows are also higher because buyers keep buying the dips earlier and earlier. It works the same during a downtrend. Lows are lower when the seller surplus move price lower, and highs are lower because sellers sell earlier and buyers are not as interested. This is the scenario of what we are trying to describe. As you can see, the market is going up, right? How did we determine the uptrend? Because we can see this high is higher, this high is higher than this one, and this low is higher than this one. Therefore, we have a higher high and a higher low, another higher high, another higher low. Seeing such arrangement of peaks within the market actually tells us what trend we are in the market within the subject. Then, as you can see, we have a lower high, a lower high, a lower low, a lower high, a lower low, going on. This also tells us that we are in a downtrend. The second method of identifying the Forex trend is by using moving averages. So moving averages are undoubtedly among the most popular trading tools, and they are great to identify the market direction as well. However, there are a few things to be aware of when it comes to analyzing trend direction with moving averages. The length of the moving average highly impacts when you get a signal when markets turn. A fast or small moving average might give a lot of entry of early and false signals because it reacts too soon to minor price movements. This we are trying to say, whenever you see a period 5 EMA, it responds differently to a period 50 EMA. Therefore, the 5 will give you early and most will be false signals because it reacts too soon to minor price movements. On the other hand, a fast moving average can get you out early when the trend is about to change. A slow moving average might provide signals too late, or it can help you ride the trends longer when it filters out all the noise. This basically means a 13 EMA can actually show you that we are going up, but the trend might not be as long as that one that can be caught with a 200 EMA. Here's the example. So this is how I use when I want to determine the trend using the moving averages. I usually love to use the 30, the 50 and the 200 to give me my bias or my trend. The first thing that I have to wait for is to see the 50-200 cross. So whenever I see a 50-200 cross, like in this scenario, this tells me that the trend is going down. And the converse is true. Whenever I see the 50 crossing the 200 in an upward manner, I would know that the trend is up. So whenever I see this, I know that I now have an initiation of another trend. I am now looking for short trades. In this case, we had this trade, we had this trade following the market trend. The third method of identifying the Forex trend is by using channels and trend lines. Although these are a bit subjective, they are also helpful. Channels and trend lines are another way of identifying the direction of a trend, and they can also help you understand range markets much better. Whereas moving average and the analysis of highs and lows can also be used during early trend stages, trend lines are better suited for later trend stages because you need at least 2 touch points to draw a trend line. What do we mean? The market needs to give you at least 2 touch points to draw your trend line for it to be valid. So you can see the first one, if we draw a trend touching this point and this point, we now anticipate price to bounce on this line in the future. So this is how we would see it. So basically what we are trying to say is what can be shown with this example, which is New Zealand dollar against Japanese yen. As you can see, we had the first point, and mind you, this was a higher time frame. The first point whereby the market gave a reversal, and another second point which gave us another point to join our trend line, and it was given as a ray. So this actually shows us that the market direction is downward move, or the trend is bearish. So after joining these points, our anticipated points of entries were bounds on these trend lines. Trend lines usually works perfectly, or works with much efficacy when drawn on the daily time frame or on the H4 time frame. So as you can see, we had the first touch, the second touch, then these were now our anticipated entry points within the market. So in conclusion, follow your plan without deviation, distracting thoughts, or hesitation to act. On that note, thank you for watching. Like and subscribe, and check out our free Signals Telegram channel. This is the link in red.